Thanks for joining David, Kevin, and myself for the educational video for the month of October. David and Kevin are going to go through a few charts, just dealing with sort of what are the important things that are happening right now. Inflation, emotionally, what's going on with everyone emotionally and how to best handle that moving forward. So as always, though, if you do have questions, please don't hesitate to give us a call and enjoy the video. Take care.
As we approach the end of 2023, we're now about 20 months into the current rate hiking cycle. And so far, the economies in North America have sailed through the aggressive tightening by the Bank of Canada and the US Fed. In fact, the US economy has grown by 2.5% here in 2023, and the US labor market remains very strong, and real wage growth remains in positive territory. For the most part, consumers in Canada and the US have largely been able to grow into and absorb these rate hikes.
It is true that interest rate hikes work on a lag, and maybe a recession is still on the way, but we should also consider the excess savings that were built up by many during the pandemic, and that a lot of debt in the United States has been termed out considerably. Companies in the US locked in low borrowing rates during the pandemic, and many consumers also took the opportunity to refinance their mortgages into low long-term rates. A large chunk of the US economy has yet to see consumption and investment impacted by higher borrowing costs. And so if a recession is still to come, it's likely to be a much shallower one than the ones we saw in 2008 and 2001, if one even materializes at all.
Looking at fixed income, yields are now at their highest level in decades. And while no one knows exactly when this rate hiking cycle will end or how much rates might increase before it does, we know we are really close to the end. In this environment, the risk-return profile of bonds is more attractive than it has been in quite some time. If rates are indeed close to peaking, it is time for investors to begin considering rotating out of cash and back into bonds. Looking out 1 year after the last rate hike in the previous 4 hiking cycles, stocks and bonds have outpaced cash 12 months after rate hikes have come to an end.
Obviously, at any point in time, there's always many things impacting the markets around the world. There's always tons of reasons to look around and be negative, and many reasons for investors to want to, run for the hills and sell everything. And now is no different. We look around and we've had interest rate hikes going up for about 20 months now. People have been calling for a recession for quite some time now, and yet one still has not yet materialized. Unfortunately, we've got a new conflict yet again in the world with the Middle East now between Israel and Hamas, and there's some fears that that could spread to other countries in the region, and what the knock-on effects of that might be on the markets. But as in the past, we've had conflicts before, we've had rate hiking cycles before, and investors who have remained patient, remained invested, monitored their portfolios during these times certainly, but largely stayed invested, stayed diversified, they've always been rewarded. We expect this time to be no different either.
The chart on your screen is a great visual to tie in David's comments. As you can see, over the last 41 years, we have experienced a number of different world events that cause short-term volatility within the markets. But when we zoom out, you can see that each time one of these events happened, investors who stayed invested not only saw their portfolios recover, but continue to grow over time.
As always, though, if you have any questions with your portfolio of investments, feel free to reach out to us.
Take care.